Picture this. You're a young professional. You've got a decent job, a salary that most people your age would consider good. And for the past few years, you've been renting a flat, clean apartment, good location, reasonable price. You've been perfectly fine. Then you go home for a family dinner, and somewhere between the second course and dessert, your uncle leans across the table, looks at you with genuine concern, and says, "So when are you buying a place? You know renting is just throwing money away, right?" And the whole table nods. Your mother nods. Your father nods. Your cousin who bought a flat at 28 and hasn't stopped talking about it since, he especially nods. And you sit there, quietly, with a strange feeling in your chest that's somewhere between embarrassment and doubt. Because you don't have a great counter-argument. You just have a gut feeling that something about what they're saying isn't entirely right. This video is for that version of you. Because here's what nobody at that dinner table told you, and what the entire rent versus buy conversation almost always gets completely wrong. Renting is not throwing money away. And in many situations, for many people, at many points in their life, buying a home is the more expensive choice, not just emotionally, but mathematically. First, let's be fair to the other side. The people telling you renting is a waste aren't stupid. They're not lying to you. They're telling you what was true for them, in their time, in their context. Your parents' generation bought property when prices were a fraction of what they are today, when a flat in a decent urban location cost maybe 5 or 6 times an average annual salary, when home loans were harder to get, so the people who did buy were generally doing so with significant equity. When rental yields, that's the annual rent you'd earn as a percentage of property value, were actually healthy, around 5 to 7% in many cities. That math worked. Buying made obvious sense. Here's what changed. Urban property prices have outpaced income growth by a significant margin over the last 2 decades. A flat that a middle-class family could buy with 10 years of savings now requires 20. Rental yields in major cities have compressed sharply. We're now looking at 2 to 3% in most premium urban markets. Meanwhile, home loan interest rates sit at 8 to 9%, sometimes higher. Read that again slowly. The property yields 2 to 3%. The loan costs 8 to 9%. You are paying more to borrow than the asset is earning, every single year. That gap, that quiet, uncomfortable gap, is what nobody brings up at the dinner table, because it's not a simple number, and dinner tables don't like complexity. Here's the mistake at the center of this entire debate. When people compare renting versus buying, they do something that sounds logical but is actually financially incomplete. They compare the monthly rent check to the monthly EMI check. Rent, $25,000 a month. EMI, $45,000 a month. Therefore, buying costs $20,000 more per month. That's the math most people do. And they stop there. But that's not the comparison. That's a fraction of the comparison. Let's actually build this out properly. Say you're looking at a modern 2 or 3 BHK flat in a well-developed urban area. A mid to premium segment property. Current market price, let's call it 1 crore. In many cities, it's significantly higher, but let's use this for the sake of simplicity. To buy this flat, you need a down payment. Typically, 15 to 20%. Let's say 20%, which is the cleaner number. That's 20 lakhs up front, before you sign anything, before you own a single square foot. Now you take a home loan for the remaining 80 lakh, at 8.5% interest. For 20 years, your monthly EMI comes to approximately $69,000. The same flat, if you rented it, let's assume it would cost somewhere between $20,000 and $25,000 per month. Or maybe a little more in most comparable markets, because remember, rental yields are 2 to 3% of property value. 2% of 1 crore is 2 lakh per year, which is about $16,500 a month. 3% gives you $25,000. So let's be generous and say rent is $25,000. So the monthly gap is around $44,000. But we're still not done. Because there are costs attached to owning that nobody puts in the headline number. Property tax varies, but budget $5,000 to $8,000 a year at minimum, often more for premium properties. Maintenance and society charges. Another $3,000 to $5,000 per month in most gated developments. The occasional repair, the painting every few years, the water heater that breaks, the bathroom tile that cracks. Budget conservatively, 1 to 2% of property value over a decade. That's 1 to 2 lakhs spread over 10 years, or about 1,000 to 1,500 per month on average. Add it up. We're looking at an additional 5,000 to 8,000 a month in hidden costs of ownership beyond the EMI itself. So, the real monthly gap between renting and buying this flat isn't 44,000. It's closer to 50,000 a month. Now, here's where it gets genuinely interesting. Remember that 20 lakhs down payment? What happens to it? In the buy scenario, it goes into the property. It's locked. It's illiquid. It's sitting in brick and concrete in a city where property is appreciating at somewhere between 5 and 8% annually in a good market. Let's say 7% to be optimistic. In the rent scenario, that 20 lakh doesn't disappear. You still have it, and if you invest it in a diversified equity mutual fund or an index fund, or even a mix of instruments, the historical long-run return from equity markets has been around 11 to 12% annually over a 15 to 20-year horizon. Let's be conservative. Let's say 10%. 20 lakhs, invested at 10% annually for 20 years, grows to approximately 1 crore, 34 lakhs. At 7% property appreciation, your 1 crore flat grows to approximately 3 crore, 86 lakh over 20 years. That sounds impressive, until you factor in what you actually paid. Over 20 years, your EMI payments total around 1 crore, 65 lakh, of which roughly 97 lakh is pure interest. Not equity, not ownership, interest. Money that built the bank's balance sheet, not yours. Then add 20 years of maintenance, property tax, and other carrying costs. Another 15 to 20 lakhs conservatively. Total outflow to own that 1 crore flat for 20 years. Approximately 2 crore or more, including your original down payment. Net wealth created from property, roughly 1 crore 86 lakh. That's the appreciated value minus what you spent getting there. Now run the renter's numbers. The renter invested 20 lakhs up front. They also had that 50,000 monthly gap we calculated, the difference between their rent and what the buyer was paying. Now, here's the discipline question. Did they invest that gap? Most people don't. And that's a real behavioral problem. We'll come back to that. But if they did, if they invested even half that gap, say 25,000 a month alongside their initial 20 lakh over 20 years at 10%, those monthly investments alone grow to approximately 1 crore 89 lakh. Add the 1 crore 34 lakh from the initial lump sum. Total wealth created, over 3 crore 20 lakh. From renting. More than the homeowner. With more liquidity, more flexibility, and none of the stress of a 20-year debt obligation hanging over their career decisions. Now I want to be careful here, because I can feel someone about to type an angry comment. This is not a straightforward that renting always wins argument. There are real, legitimate reasons why buying makes sense for specific people in specific situations. If you're buying in a market where rental yields are reasonable and appreciation is strong, the math shifts. If you're buying with a large equity component and a short loan tenure, the interest burden drops significantly. If you genuinely need stability, a fixed address for children's schooling, aging parents, a business location, that has real economic value that doesn't show up in a spreadsheet. If you're in a stage of life where forced savings via EMI is the only way you'll actually accumulate anything, because most people won't invest that 25,000 monthly difference. Let's be honest. Then the behavioral argument for buying is real. Property is also a hedge against rent inflation. If you're in a city where rents are rising fast and supply is constrained, locking in an EMI today might protect you against higher rent costs in the future. That's a genuine calculation worth doing. And there's something real about what ownership gives people that money doesn't fully capture. A sense of permanence, the ability to renovate, repaint, knock down a wall, the comfort of knowing nobody can ask you to leave. These things matter. They're not irrational. But here's the problem. None of these nuances are part of the conversation people are actually having. The conversation people are having is, renting is throwing money away. Full stop. No math, no context, no opportunity cost, no acknowledgement that a 20 lakh down payment is real capital with real alternative uses. No mention that the first several years of your EMI are largely paying interest. No discussion of what your borrowing cost is versus your rental yield. Just a moral judgment, dressed up as financial wisdom. And that moral judgment is costing people, not just money. Options. Here's the part of this conversation that rarely gets said out loud. The advice to buy. Always buy. Buy as soon as possible. Rent is waste. Is advice that was calibrated for a different economy. An economy where property was cheap relative to income, where alternative investments were either inaccessible or poorly understood by ordinary people, where inflation was higher and real returns on financial assets were less reliable. That economy no longer exists in the same form. Someone in their early 30s in a major city is looking at a 1 crore flat that requires 20 lakh upfront and a 70,000 EMI for 20 years, consuming a significant fraction of their take-home salary for 2 decades. That same person has access to low-cost index funds, systematic investment plans, and diversified financial instruments that their parents' generation simply didn't. The rules of the game changed. The advice didn't. And so, a generation of people in their late 20s and early 30s are making one of the largest financial decisions of their lives based on inherited logic that was never designed for their circumstances. They're buying flats they can barely afford in cities they might not stay in, taking on debt that limits their career flexibility, stretching themselves thin to hit a milestone that was defined by a different generation's economic reality. And the ones who choose to rent instead, who invest the difference, stay mobile, keep their options open, they sit at family dinners feeling behind, feeling like they haven't done the adult thing yet. That guilt is not financial information, it's cultural pressure wearing the costume of wisdom. So where does this leave you? Not with a simple answer, because there isn't one. Anyone offering you a simple answer to this question is selling you something: a loan, a property, a sense of certainty they don't actually have. What this leaves you with is a better set of questions. What is the rental yield on the property you're considering buying? What is your loan interest rate? What is the gap? What are you actually doing with the capital you're not putting into a down payment? Is there a plan for it, or is it just sitting there? How long are you realistically staying in this city? What does your life actually look like in 5 years? Not your parents' version of your life, your actual life. These are the questions that matter. Not whether renting feels like renting, because money doesn't care about feelings. Money doesn't care about tradition. Money doesn't care that your uncle nodded at a dinner table. Money responds to decisions, to math, to time, to what you actually do with it. And sometimes, maybe more often than anyone in your family will admit, the most financially intelligent thing you can do is rent. Not because you can't afford to buy, because you're smart enough to know the difference. We'll keep looking at the numbers nobody shows you. See you in the next one.